Welcome to Tip TV Finance, where I'm joined by Marc Ostwald, who's a strategist at ADM Investor Services. How are you today, Mark?
I'm very well, thank you.
Yes. Have you been enjoying the week?
Yes, it's been an interesting week. I think it's a contrast because we had a lot of hype ahead of both the Fed decision and indeed the Dutch elections. I fear that the Fed would be more hawkish than it was. And then we got this rather ridiculous oxymoron of a comment post the Fed that they'd given us a dovish Fed rate hike. It's like, well, no, a rate hike's a rate hike and it's never dovish, but we'll leave that aside.
But wasn't Yellen saying, you've got, it's like, because she's a dove anyway, so you've got your rate hike now, just, like, leave me alone or don't keep pestering me. It was that is a sort of dovish rate hike, let's say.
Well, no, I think it was what I'd call a holding pattern type rate hike because they've got a lot of uncertainties, particularly in respect of what's going to happen with fiscal policy. So they know they need to go. It was probably a goodest moment to slip a rate hike in. They're on target for the time being for 3 hikes a year for the next 3 years, which is totally improbable. We'll leave that aside. I think the market reaction was the interesting part because there was great relief at that. There was great relief that Mr. Wilders didn't turn out to be the power within the next Dutch Parliament that some people thought he might be, and thus allaying some of the fears, I would say only some of the fears, about populism getting hold in Europe and the whole EU, Eurozone project falling to pieces. And then yesterday, we suddenly get ourselves a shock because the market reaction post the Fed, post the Dutch election was, we haven't got anything really which is jarring sentiment here. So back to every form of risk on, buy equities, buy credit, buy commodities, and off we went. And then suddenly, yesterday lunchtime, we got the BOE rate decision, and there was one dissent. But markets took it very amiss. And I think it's interesting the way that it shifted because, first of all, Kristen Forbes is actually leaving in June. So in terms of the formulation of BOE policy, what happens going forward, she's not going to have a say in it. Secondly, yes, there were a number of other people who apparently were concerned that inflation was rising too quickly here in the UK and that they might need to up the pace or go to a more hawkish stance. But we've heard this all from the Bank of England many, many times before. I think a lot of the time people on the MPC say, of course, if inflation were to go above our forecast, then we'd have to react. And then when push comes to shove, they don't. But nevertheless, it's interesting in terms of the tables that we've got now. Bank of England rate expectations. Okay, so we've not changed markedly, but for the end of the year, it is noticeable how we've started to ratchet up expectations for that December meeting. It's still definitely not priced in as a rate hike by any manner of means yet, but it's shifting higher. So we're actually starting to see the market saying, well, as much as the Bank of England's still not forecasting a rate hike until 2019 because of its inflation forecast, the market's saying, well, actually, we don't really believe you. And that's an interesting change in the narrative. And the same applies with the ECB. And one can see it on the next table of ECB rate expectations. Now, that has been a much sharper shift, as one can see in the bottom chart. Those are expectations for the December meeting. And it's definitely ratcheted up. And that was all in response to a comment by the Austrian Central Bank Governor and ECB Council member Jens Novotny last night, saying we will make a decision later in the year on whether we taper or hike rates first. He didn't actually make a commitment. He just said it will be later. And suddenly the market, we had the Euribor curve shifting very sharply.
But now you've got a time frame. Before you didn't have a time frame, did you?
Well, he said later. He didn't actually say by the end of the year.
Yeah, okay.
Implying perhaps later in the year we might make a decision along that line. But it does basically tell us that the rate environment in the background on top of the Fed is gradually shifting. And this is where I think the echoes of 1987 are an interesting one. There's never been quite as much gap risk in financial markets as there is now. And the gap risk is obviously there because there's been this massive central bank put in place for best part of 20 years, but emphatically for 10 years. And so markets never actually believe that central banks will get aggressive again. And yet, if you look back at 1987 and you look at the echoes, given we've got a G20 finance minister and central bank meeting today, and you look at some of the echoes from back then. Back in 1987, the US and Germany were having a big old face-off about the level of dollar mark, equivalent dollar euro now. We know what the Trump regime thinks about the level of the euro relative to Germany's trade performance. Back then, with a much larger trade deficit, one would have to add, the US was complaining about the size of the German trade surplus. Quelle surprise, we've still got that going on now. And back then, financial markets chose to ignore the threat that the Bundesbank might hike rates. And we know what happened actually after all this had been escalating and escalating for months. On that fateful Black Monday on October, the week after, the Bundesbank had surprisingly hiked rates because it saw inflation expectations picking up. Wham bam, we saw a big stock market crash. And for those who have the time, a little exercise for you. It's well worth making a comparison of the performance of the Dow back in 1987 and mapping on top of it year-to-date performance of the S&P 500 and noticing that there is actually quite a spectacular similarity. And this is where we come to my final bit, which is about the number 7 in years. We know the 1970s were pretty horrible for financial markets. Spectacular rise in interest rates, very poor performance, particularly in the early half of the decade. So that was the 7s then. 1987, I've obviously just mentioned. 1997 was the year of the Russian, Thai, and LTCM crises. And 2007, I think it's fresh enough in everybody's memories. This year is 2017. I'm not making a prediction. I'm just saying years with 7s don't necessarily tend to be great ones for financial markets.
I think it's got a lovely ring to it. But so, I mean, we should be... I mean, you're basically saying, though, that it's just that transition from ultra low interest rates to normalization. It's almost impossible to have a smooth transition. You just don't really have that.
Yes, I think the lesson from this week is if everyone's going to take comfort that the Fed could slip in another rate hike 3 months after the last one, unlike what we've seen in previous 2 years, and it all goes smoothly and financial markets won't be upset by it, it's probably not a good idea to be that complacent. I think just the risks there, you've not really seen any widening in credit spreads of a material money, but we have seen in certain sectors some quite sharp outflows. Last week was a record outflow since 2015 for high yield bonds in the States, almost 6.82 billion out of mutual funds in the States. That's a very substantial amount. Given the price performance of the junk bond ETF in the States yesterday, I would suggest some of the money is flowing back in post-Fed, but it's going to get a lot choppier as we go on, and I don't think the calm that we've seen this week is something we should see as something which will remain a phenomenon.
Marc Ostwald, strategist at ADM Investor Services, thanks for coming in today.